The jobs report lands today, and markets are already moving in anticipation. Futures tied to the Dow Jones Industrial Average, the S&P 500, and the Nasdaq all pushed higher in early trading. That early optimism is less about any new development and more about positioning. Investors are bracing for one of the most market-moving data releases on the economic calendar, the monthly employment situation summary from the Bureau of Labor Statistics. So what exactly is in this report, and why does it matter so much right now? The employment situation summary tells investors three things: how many jobs the economy added last month, what the unemployment rate looks like, and whether wages are rising. Each of those numbers can move stocks, bonds, and currency markets significantly, because together they paint a picture of how healthy or fragile the economy actually is. Right now, the Federal Reserve is watching this data especially closely. The Fed has been holding interest rates at elevated levels in an effort to push inflation back down to its 2% target, without tipping the economy into recession. That is a difficult balance to strike, and the jobs data is one of the clearest signals of where things stand. Here is the basic logic. If hiring is strong and wages are rising fast, that keeps consumer spending elevated, which can keep inflation sticky. A strong jobs number might lead the Fed to hold rates higher for longer. On the other hand, a softer report, fewer jobs added, wage growth cooling, could give the Fed more confidence that the economy is slowing enough to justify cutting rates later this year. Markets have been extremely sensitive to any signal about the Fed's next move. Interest rates affect the cost of borrowing for businesses and consumers. When credit gets cheaper, companies can invest more and earn more, which tends to lift stock prices. That is why rate cut expectations often spark rallies, even before any actual cut happens. The pre-market gains seen this morning reflect that dynamic. Traders are hoping for a jobs number that is soft enough to keep rate cuts on the table, but not so weak that it raises fears about a slowdown. That is a narrow window, and the data could easily fall outside it. Futures markets can shift sharply the moment the official numbers cross the wire. The headline jobs figure will draw the most attention, but watch the prior month revisions too. Those revisions can quietly change the story and catch markets off guard. The practical takeaway: when a major data release is this anticipated, the first market move is rarely the final one. Let the dust settle before reading too much into the opening bell reaction. This briefing is brought to you by First Financial News, clear daily coverage of the economy and markets at firstfinancialnews.com.